Okay, good morning to everybody. Today is the 6th of November, and we're going to pick up from where we left off last time and talk about Chapter 10. Chapter 10 is not a particularly long chapter, but there are a number of things going on. We started talking about PP&E, property, plant, and equipment, and the ways that we handle the acquisition of those. And in terms of, obviously, different types of transactions, where it's not always just a case in which a firm buys a fixed asset with cash or whatever, but sometimes there are other alternative means by which this is done. And these are not as unusual as what they may seem. It seems like a lot of times students in intermediate accounting or sort of of the opinion that we're really covering these sort of one-off obscure types of transactions. And some of them are, frankly, but not all. And certainly in terms of things like swapping an asset for another asset, that's not as unusual as what it might seem. So we'll talk about that today. Notice that the Smart Book quiz is going to be due this Friday, so by 11 p.m., and then the homework and bonus by 11/9, which is Sunday. I'll decide what to do as we get into Chapter 11. Chapter 11 is a much lengthier chapter, and I'll let you know as to due dates. As I've said numerous times before, I really like to give people more time to work on assignments as opposed to less. And I do try to look ahead to see what's coming and what is and what's required, and I try to sort of gauge due dates in order to sort of accommodate that. So remember, every instructor used to be a student, and so I'm very familiar with what you're sort of dealing with here. So we're going to talk about Chapter 10 some more. And we'll get into a bit of intangibles here. And this is a pretty big section of this chapter, mostly because of the fact that intangibles are a little bit different. There's no physical substance to them typically. They involve things mostly, as I mentioned earlier, like legal rights, and what are those rights entitled a firm to do? And why would we pay for these legal rights? And we pay for legal rights because the fact that they can create value in the longer term situation. So that's where we are. And when we come back on Tuesday, we'll talk more about Chapter 11 and go from there. I will probably, as it looks right now, probably do a supplementary video at some point. Probably Friday. We're in the county department's in meetings in the morning, but it'll probably be in the afternoon on Friday to sort of round out what I don't get through today, just because I kind of have a pretty good sense of how far we can go in an hour and 15-minute class. And intermediate accounting is one of those courses in which we often don't have enough time to sort of get through everything we need to get through, but we'll do our best. Okay. All right. So let's talk about intangibles. I cut this. We saw this slide last time. This is, I think, at least from my note taking, this is where we ended up on Tuesday, where we talked about what are intangible assets as a category, not specific to any individual item on the balance sheet, but what are these what are these assets that fall into this category? And we're saying that they like physical substance, and they really involve rights. And when we talk about what to do about these, do we amortize these over time? Do we not amortize them? Remember, amortization is simply the process of taking an asset and devaluing it over time on a balance sheet because of the fact that it's a cost allocation mechanism. Much like depreciation, which is somewhat misunderstood by a lot of people, the idea that depreciation is bringing the asset to its market value, but that's not always the case. In fact, that's not often the case, and we're going to talk much more about this this sort of misunderstanding, this misapprehension between market value and book value, and how book value sometimes misses the mark when it comes to this, just simply because of the accounting standards that we're applying. But when it comes to intangible assets, and by the way, depreciation is really a form of amortization. So amortization is simply the logical reduction in value of an asset over time, due to the fact that it's losing value and we're spreading out the cost of that asset in order to sort of better match the cost of that asset with the benefits to be received over time. So if it's got a finite useful life, if we know that the asset's going to expire at some point, i.e., patents is a good example, right? We know that patents 20-year life, it's going to go away. And so as a result, we're going to amortize the value of that over time. And as a result, we're going to bring it down to zero. And by the way, one of the classic examples of how a patent becomes practically worthless at the end of the day, or does become worthless, I should say, is the drug industry, which has a new drug for whatever. There are all kinds of drugs out there. And the second that thing goes off patent, You've got a half dozen other competitors who've got, products that do much the same thing. I don't want to say identical, but they do much the same thing, and they sort of fill the void because that patent is no longer, bestowing upon the owner a sort of monopoly pricing power. And so that's why we would amortize it. If there's an indefinite useful life, we're going to say it's not amortized. And so things involve trade names and logos and whatnot. The Coca-Cola logo has been around for a very long time. I doubt that you would design a logo with cursive writing today, but we all know that logo. And as I've said, I think on Tuesday, that patent lawyers will say that it's necessary. And by the way, we use the term patent lawyers to sort of apply to a lot of these IP type, intellectual property type assets. They have said that if you don't defend it, then you're sort of implicitly giving up the right to that particular asset. So defending these intangible assets is an important piece of it. And by the way, we sort of capitalize the cost of the defense, the legal cost, back in the cost of the asset itself. That's how important we believe the idea of defense of these intangible assets and the rights to those assets are. So that's where we left off. Well, let's get to goodwill. And this is something I don't believe we've talked at all about this yet. Let me see here. Oh, this is just a roundup of all these. And so I'm not going to go through these. I think I did, I think I went the wrong direction, actually. And this is just sort of a roundup of all these patents, copyrights, trademarks, franchises. We talked about all these on Tuesday, but I do want to get to goodwill and talk about what goodwill is. This is an often misunderstood accounting line item on a balance sheet, and sometimes it's a big number. And I know in my 2110 course, which is the introduction to financial accounting, I have shown sort of the growth in goodwill on companies' balance sheets. So what is goodwill? Goodwill simply is an accounting, let's just call it a plug number that represents the difference of selling price over book value, because the fair value of assets, and remember, fair value, also called fair market value, is what an asset is worth, so to speak, in a market between two parties in an arm's length transaction that is unrelated parties. And sometimes companies are willing to pay more than that. So why would they be willing to do that? All kinds of reasons. Maybe it could be the asset itself could be better managed by the acquiring company. Sometimes companies think, hey, what you've got here, you really don't know what you've got, don't know how to deal with it. We've got the staff, we've got the management, we've got the distribution, whatever. And so we want to acquire this from you. And sometimes sellers will say, okay. And particularly if they're going to get premium over fair market value, not just book value, which could be massively depreciated if we're talking about, a lot of depreciable assets, but over the current market value. And so all these things are elements that represent a need for accountants to value this premium paid over market value, or fair value. So we're talking about clientele, that is, you've got a client list, and it maybe jives very well with what the acquiring company's clients are currently dealing with. Employees and management team. This is not to be sneezed at, because a lot of companies have lost managements. I mean, when thinking of Tesla, which has lost a lot of talented managers, and I'm not here to sort of pass judgment on any particular company, but you've got to think, and I'm not saying this has anything to do with goodwill at all, because I'm not sure Tesla's for sale, but what I'm simply saying is that management teams are very important, because it really is the people who run the companies. And so, and there's a lot of talent there that may be desirable from an acquiring company's point of view. I worked for a company that was acquired by another company. One of the rationale that was given for the premium paid over really the entire fair market value of all the assets was the management team, which was considered to be quite talented. I'm not patting myself on the back. I don't think they were talking about me at the time, but that's what's going on. Or favorable business location. We could talk a lot about all kinds of different assets. Maybe the synergies that are derived from the products that are owned by the company that's being acquired. Maybe they fit in very well with the acquiring company. Maybe there are a lot of synergies there, and so as a result, the company really desires those. We should also mention that sometimes, barring any sort of antitrust concerns, sometimes it makes sense for a company to buy another company simply to take that company off the shelves and out of the mix in terms of competition. So if you go back about 25 or so years, when Hewlett Packard bought Compaq. So Hewlett Packard, obviously, we know them as being a tech company. It's a hardware company primarily, I guess, but they bought Compaq, which was primarily a personal computer market. Made very good products, and people at times thought, why are they doing this? And one rationale that was offered was the fact that it was taking a competitor out of the picture, and as long as it doesn't involve antitrust issues, which we talk a lot about in microeconomics, that is, unless it's anti-competitive in nature. And by the way, the government weighs in on what's anti-competitive and what's not. Sometimes it goes to the courts, but as long as that doesn't happen, then it may make sense to take the competitor out of the picture. And even though whether that company is a strong competitor or not, it doesn't really make any difference. But you also acquire everything that company owns, presumably. By the way, goodwill can only be acquired; it cannot be internally generated. This is important to know. You cannot generate goodwill and say, okay, we're going to sort of invent $1 billion of goodwill because of the fact that this is what we value our management talent as or whatever. It can only be acquired, and it really represents this premium paid over fair market value. And that's essentially what's going on. The problem with goodwill, I don't know if problem is the right word, but it becomes difficult to value for very long time periods, and we'll talk about that. Back in the day, we used to amortize goodwill. We no longer do that. Goodwill can be impaired, and impairments, I think we talked more about in principle in the intermediate two. Impairments are where an asset simply is no longer as valuable as what it is being reflected. And there's a concept everywhere in accounting where we bring down the value of that asset if it has been impaired for whatever reason. Even things like inventories and certainly receivables. We've certainly seen that bringing down the value of receivables if there are issues with collectability. But when we talk about goodwill, it can't be separated from a company. So a company or division or subsidiary or some large unit of an acquired company. And so what is the cost of it? What's the fair value given in exchange, whether it's cash or whatever, minus the fair value of the identifiable assets acquired. And that essentially represents what's going on. So it's this difference here, minus any liabilities which might be assumed. And sometimes companies do assume liabilities of other companies. And obviously this involves a little bit of complications where the debt holders, that is those to whom the debt is an asset, may or may not be agreeable to it, but that's a little bit of an area that we don't really want to get into here. Just from the accounting standpoint, we're saying this difference between these two fair values, what's given up in order to get what's gotten, and then what is the difference here? And that is goodwill. Of course, we have to take out any liabilities because the fact that liabilities become a liability on the balance sheet of the acquiring company. So that has to be sort of removed from the equation here in order to make the goodwill calculation. So let's do a couple of examples here and show what's going on. So Smithson Corporation acquired all the outstanding stock of Ryder in exchange for 180 million in cash. So this is a cash transaction. Smithson, which is the acquirer, assumed all of Ryder's long-term liabilities. Okay, so that's an area where we would have to make that adjustment to any kind of goodwill because of the fact now we've got a liability. From the standpoint of Smithson, and this is the standpoint that we're looking at here, has that particular new liability. So the fair value of all identifiable assets are as follows: receivables 50 million, inventory of 70 million, PP&E of 90 million. Together, that's 210 million, something like that. And a patent of 40 million, so it's 250 million. Okay. All right. So we're paying 180. Okay, but we're also assuming 120 million of dollars of liability. And so as a result, what's going on here? The only way to make this work is to plug in a value as the premium for goodwill, because what's going on here is we're paying more than what these fair value assets are, minus any liabilities, because of course we're assuming the liabilities. And so as a result, $50 million becomes booked to goodwill. And again, the price of anything, I mean, I think we just have to be honest, is negotiable. It's subject to debate and negotiation. If it weren't the case, why would a stock that traded for $50 on Thursday trade for $30 on next Tuesday, right? Or that's maybe an extreme example, but you get the idea. I mean, if the price were the true value of something, whatever that is, then then we would have this fluctuation in values. But we do, and things are in flux because it really represents what is the value of that good based upon what's going on. By the way, it really doesn't make any difference. I know it sounds crazy to say, but it really doesn't make any difference what the price paid is, because from an accounting standpoint, I'm going to book the price of those assets as a new asset on the acquiring company's balance sheet, and we're going to sort of go from there. And there are all kinds of examples, and I mean all kinds of examples, where companies have overpaid for another company, and it turns out it was a big, huge mistake. And it's difficult to sort of reconcile it. Uh, America Online buying Time Warner back in the late 90s, early 2000s. Just a ridiculous transaction. One of the worst, where an acquiring company that didn't really, in fact, this was a case where the acquiring company really probably wasn't all that valuable. The acquired company was much more valuable. And as a result, the thing didn't really work out. And that's sort of a backwards example of what I'm talking about. What I'm saying is, though, that these prices are sort of flexible and negotiable, and it's really difficult to sort of piece out what is fair and what's not. The only way that we can sort of work this out is the idea that whatever premium is paid over and above the book value, fair value, not book value, fair value, is going to be booked to goodwill. So here's what the transaction looks like. These are the journal entries. The receivables, 50 million, inventory, 70 million. Obviously, we're cutting off 6 zeros. PPD 90, patent 40, and then goodwill becomes an asset. So it's got a debit balance. And so that's the figure that we're going to put in there in order to balance out the cost of the transaction overall. Okay. So that's essentially what's happening there. Okay. And then, of course, the liabilities, which we're assuming now, go on to the acquiring company's books as a liability. And then 180 million was the purchase price. And by the way, this should be, that's the difference there that we're reporting. Okay. Okay, different example here. The Dearden Golf Ball Company acquired all the outstanding common stock of Sanderson Golf for $1,750,000. The book values and fair values are on the books as the date of purchase as follows. Okay, well, we have book value. That's one thing. We have fair value. That's another. Okay, fair value is a little bit different than book value in all of these cases, with the exception of the liabilities, which are a little bit less subject to this sort of fluctuation. So the question is, how should we record goodwill? Well, the purchase price is $1,750,000, but they're acquiring what? They're acquiring all the outstanding common stock for $1,750,000. So 415 plus 1,470,000. And as a result, what is the value here? Well, okay. Well, we're assuming the liabilities too, so we have to include that. So 415 plus 1,470,000. Not the book value. We're not interested in the book value here. And it's not that book value is not important, but it's I guess it becomes important when there are large variances between book value and fair value, but it's really fair value that we're talking about. And it really falls to the acquiring company to do its due diligence and to determine the fair value. So the fair value, $415,000 with the current assets, the PPD, $1,470,000, minus the liabilities, because we're now bringing those on the books. And so as a result, the book values are going to be this. And so the amount that, what are we being asked for? The amount of, where are we here? Goodwill. Goodwill is 165. That's simply 1,750,000. That's the purchase price minus the fair value of current assets, minus the fair value of property, plant, equipment. And we have to then go the other direction with liabilities that are being assumed. So 165 becomes the value of goodwill. It's the only way to make the transaction balanced. Now, where did 1,750,000 come from? Well, it came from presumably negotiations between Dearden and Sanderson, and that's the value that was agreed upon. But to make the accounting numbers work, we have to include a value of goodwill. And sometimes these goodwill numbers are not small. Sometimes they're extremely large, in the billions, tens of billions, and whatever. And so, and goodwill, because a lot of companies have been buying other companies, and this is not new. This didn't start last week, but there's been a lot of acquisition of one company to another. And the way to sort of make these things balance in terms of the fair values to book this to goodwill. And goodwill is simply a premium paid. By the way, it's also sort of an inducement to selling companies to sell out to another company. They're getting a premium even over the market value, not the book value, but over the market value, the fair market value of those assets themselves. And so oftentimes this is a motivation to sell. And there are a lot of companies that have started up in areas where there's growth opportunity, and they expect to sell to somebody else. That's their expectation and that's the end plan. It kind of violates what we call the going concern concept in economics. They intend, or in accounting, accounting and economics, they intend to sell the company, and that's really the entire goal in the first place, and to reap that, and to obtain that sort of premium. So it's something to consider, and there are companies that do that, and I've been involved with companies that have done it over time. So they're going to transfer assets to the fair market value, not necessarily the book value. And by the way, book value, as I've said before, is misleading in any case. Sometimes it doesn't always look like what is the actual market value. And it's maybe one of the shortcomings we have in accounting is the idea that we have assets on the books at book value that is acquisition cost, which may have been many, many years ago, minus accumulated depreciation, and that may not be totally reflective of what's going on with respect to the value of that asset itself. And so this is an area that's been controversial for a very long time. However, I will say that there is an argument to support this historical cost basis of book value reporting. And so I don't look for this to change anytime soon in terms of marking everything, doing what we call mark to market on assets. I just don't think it's going to happen anytime soon. So okay, any questions? We have so let's talk about lump sum purchases and what's going on here. So when we talk about lump sum purchases, what we're really saying is, okay, I'm going to give you $1 figure for all these different assets, and they have different acquisition dates and costs and accumulated depreciation and book values and fair market values and all this. And we're going to say, okay, let's just call it even. We're going to give you X dollars. And in this case, it becomes really difficult to sort of sort of piece out each individual asset that's being purchased. And so in this example, this is a pretty simple example where we're buying the delivery trucks, and there are 10 of them, and we're going to pay $150,000 for them. Even though, as we've said here, they may have different characteristics. When we say identical, are they really identical? Were they purchased at the same time? Do they have the same engine characteristics, the same mileage, the same condition, all that? Do they have the same useful lives? So what we're going to do is we're going to sort of allocate this one price among the specific items. And we're going to do it in a way that allows us to sort of take this new acquisition cost and allocate it to each individual asset on the balance sheet so that the acquiring company going forward can then depreciate those assets. If they're depreciable, in this case, trucks clearly would be, and we can go forward from there. So it's an example given. An exact acquisition of factory includes assets that are significantly different. Okay, so it's going to be different when we have each asset is indistinguishable, and when they are very, very different. Okay, and we're going to see a couple of examples here of really both of these cases. We're going to see a factory includes assets that are much different: land, building, and equipment. Obviously, these are not the same assets. It becomes a little bit tricky, but not that tricky. And we'll do the math here, and we'll sort of show what's going on. We're simply going to take the acquisition price, and we're going to divide it essentially by the fair values. Now, again, we're talking about fair market value. Okay, so let's talk about this. So in this case, the example we're given is the Smyrna Hand and Edge Tools Company purchased an existing factory for one sum. Remember, this was a lump sum purchase, $2 million. Okay. And by the way, this is not uncommon that a company will say, I'm going to buy another company. $2 million would not be a public company, probably, right? I can't imagine it would be. But then again, a lot of the examples we use, even though we talk a lot about the fact that we're sort of geared toward public company accounting, a lot of these examples do not involve those. And so in this case, $2 million is the purchase price. The price included the land, the factory building, and the equipment, and also a patent on a process. Now, what we're going to do is we're going to find out what the fair values are. Where does that fair value number come from? Well, an independent appraisal, and there are people who go around appraising business assets. I certainly saw these as a commercial lender, particularly when we were looking to move in on collateral. We wanted to find out what the equipment was worth, what if we had to repossess it. That wasn't common, but we know they're out there, and that's not the only purpose. That's not the only function, clearly, but certainly independent appraisers are out there who can value land. Real estate appraisers there are a lot of real estate appraisers who can value land and buildings. And so in this case, we're going to say the fair value, not the book value, the fair value not the book value reflect on the acquiree, but rather the fair value in an arm's length transaction. $330 for land, $550 for the building, $660 for the equipment, $440 for the patents, and $220 for the inventories, which add up to $2,200,000, which is larger than the acquisition price of $2 million itself. Okay. So think about this. Now we have to allocate this. Okay. Now we're not talking about goodwill here. We're talking about allocating the cost of these assets among the different grouping of assets. Okay. And these are all groups of category. We're assuming this is not one piece of equipment worth 660 or whatever. The patent we don't really know. It doesn't really matter. It doesn't matter. So we're saying 2,200,000. So if you just take 330 divided by 2,200,000 again all the way across, they're going to add up to 100%. So the allocation of total value to these specific 5 asset categories, 15% is 25, 30, 10%, 20%, 20%, 20%, 10%. They're all going to equal 100%. What are we going to do with those values then? We're going to take those then and we're going to spread those out now across the acquisition price. And so remember, the acquisition price is $2 million, not $2,200,000. Okay, not $2,200,000. Now, by the way, maybe the fair market value is more, but at the same time, you might think, well, why in the heck would you want to sell a business for $200,000 less what the fair market value of the assets are? Well, one thing, it's not always easy to sell assets. And we're talking about things like equipment that has a specific use. I was involved one time with a company that owned a sawmill. How many people wanted to buy a sawmill, for God's sake, right? They were trying to find buyers. And they were trying to acquire the assets. And they wanted us to try to find a buyer for them. And it's like, this is not... I had never met a person in my life who said, I want to go buy a sawmill, right? But they're out there, I'm sure, i.e. other sawmill operators, but you get the idea. These are not, this is not like selling your, 2017 Chevy Malibu. You're probably not going to find a buyer for a lot of these. And so you're going to take what price you can get. And that's sort of what's happening here. So in this case, remember, take these percentages that we got previously, right? Let's go back to the previous slide here. Remember, these are the percentages that we said with the fair market value as in relation to the total fair market value. So 15% for land. So 15% of the 2 million, not 2.2 million, but 2 million is 300,000. And then we had 25% of the 2.2 million, which now is applied to the 2 million. So we get 500,000 all the way across the line till we end up with $2 million. And so what does this mean? And let's forget about expenses here, legal fees and all that. We would probably deal with those a little bit separately. All we're simply talking about is the acquisition cost and how we book them on the books of the acquiring company. That is, if we're the accountants for Smyrna, what would we do with these? We would say land, 300,000, building, 500,000, and all that. And let's not worry about things like how we depreciate going forward. We can kind of deal with those. There are some tax issues here that are going on. I definitely don't want to get involved in that. But all we're really saying is this is how we allocate the value of these assets. It's not really all that complicated. Once you sort of look at it, all you're simply doing is saying, okay, if these assets are worth 2.2 million, and we've appraised each individual category at these dollar figures, what is that percentage in relation to the total fair market value? And then, because it's going to go back to the acquisition price, not the fair market value, because the acquisition price is 2 million, we're going to simply apply those same percentages to the acquisition cost in order to get the $2 million. Because why? Because we have to remember we're buying assets worth $2 million. We got to have those assets worth $2 million on the balance sheet of Smyrna. We can't have, they're not 2.2 million, it's $2 million. Now, if they want to sell those assets down the road, that's entirely up to them. We're going to get to that sort of accounting treatment a bit later, but we're assuming that they're acquiring it for a legitimate business purpose, and so as a result, they're paying $2 million for those assets. And all we're doing is simply spreading out the cost of those based upon their relative contribution to total value, based upon the original fair value. Now, one thing that we should talk about is the idea that sometimes we really don't always know what the fair value of assets are. And we're going to get to that in a second. it sounds a little bit ridiculous to say we don't know what the fair value is, but sometimes, value itself is a squishy subject. I mean, it's not as firm as what you might think. And it really drives me crazy when I hear people say, well, that's what this thing costs. It's like, what do you mean that's what this thing costs? It's like, whatever this thing costs is whatever I'm willing to pay for it, right? So, that sort of thing. And so, and you really have to sort of view that as, in the business world, a lot of things are negotiable. It's not the case that this has come down from Mount Sinai as this is the price of a piece of equipment, right? This is not etched in stone. This is something that's more flexible. And yet, as accountants, we are tasked with trying to put values on these. And in this case, this is the way we would handle a lump sum purchase. And so, given all these facts here, these are the journal entries down below. All we've really done here is reproduce these, the previous calculations. And so we have debits to all these. And and by the way, the cash figure should be here. Looks like they got the wrong line there. So cash is a credit for $2 million. It's a cash transaction. We're buying all this stuff. And so we debit all these things. This is the new value that we're capitalizing on the books. These are all long-term assets, PPD, right? Except we do have an intangible here. And so all these, land is obviously not depreciable, building is, equipment is, inventories are not depreciable. We don't depreciate inventories, but the cash then is the balancing transaction here, and it should be on that line there. So those are the journal entries. And as we go forward, we simply incorporate those assets into the business itself. And this is how we handle the accounting treatment for it. Okay. All right. So any questions about that before we go forward? You can enter something in the chat box or give me a shout out here if you'd like. And if you're watching the delayed video, which is what seems to be most people's preference, feel free to reach out to me if you also have questions down the road as well. So, okay, another example, Cirrus Corp acquired a manufacturing facility on 5 acres for a lump sum price of $32 million. The land included improvements, such as landscape. We talked a bit about improvements earlier, parking lots, pavement, all that, fences. According to independent appraisals, the fair values were $18 million, $12 million, and $10 million for, respectively, for, I'm guessing here, in the same order, land for lump sum price. Well, I guess building and land improvements. Here, yeah, building and land improvements, right? So 18 for respectively, 18 million for the building, 12 million for the land, 10 million for land improvements. The initial values of the building, land, and land improvements would be what? All right. Well, that's the question. How do we value these based on what's going on here? We're paying $32 million for assets which are worth $40 million. Okay. 18 million plus 12 million is 30 million, plus another 10 million is 40 million. Okay. Well, it's not going to be the case where we're booking them at their fair values necessarily. We're going to do some estimation here. So in this case, what do we have? We're going to take 18 million divided by the 40 million, which is 45%, times that purchase price. Remember, it's the acquisition price, which is 14.4. That's just for the building. 18 divided by the 32, right? And we have land now divided by the 40 million acquisition. Fair market value. Fair market value. 18 million divided by 40 million fair market value. 18 plus 12 million is 30, plus 10 is 40. And so we have an acquisition price that's less than the fair market value. So it's like the previous example. It's almost identical in that respect. The building, 18 divided by 40 is going to be 45%, which would then go to apply back to the original purchase price. So the building is not 18 million, even though that may be the fair market value individually if we were separating that out from the other assets, but we're not. This is a lump sum purchase, and so we're allocating that cost. 45% times 32 million is 14,400,000. The land, same deal, 12 million divided by 40 million is going to be 30% times the purchase price of 32 million, which gives us 9.6 million. And then the improvements of $10 million, which is 25% of the total fair market value, times 32 million gives us 8 million. So remember, we need to add up to 32 million. So 14.4 plus 9.6 million gives us what? $24 million plus $8 million is $32 million. And that's how we allocate those costs, those assets. We're taking those as their percentages in relation to the fair value, first of all, And remember, companies are looking at fair value as an important measure of what's going on, but it doesn't mean that they're going to pay full price. In this case, the last two examples we've seen are cases in which the companies that are acquiring are paying less than the quote unquote market value. But again, market value, I don't mean to beat this dead horse, is itself sort of squishy because we really don't know. And this is why a lot of accountants don't trust this idea of fair market value accounting, because who's to say what the value of anything is, right? But this is the best we can do. But if somebody's paying a price, that's a pretty good approximation. And it's long been held in accounting circles that if somebody's willing to pay something and somebody's willing to accept something for it, then that must be what the value of that thing is, right? Otherwise, what the heck is the value of anything? It's what somebody's willing to pay for it and what somebody's willing to accept for it. So that becomes the new value. And so we're not taking this on $40 million of assets. We're taking this on $32 million of assets. And so as a result, the acquiring company is going to be booking these individual assets on their books at those particular values because they reflect the acquisition price. And therefore, it is not at all a departure from what we call historical cost accounting. We're simply saying this is what it cost to acquire these assets. And we put assets on the books pretty much always at the value of the cost of acquiring those assets in the first place, particularly when we're talking about long-term assets. Okay? All right, so that's a pretty good example of what we're sort of getting at here. All right, let's go to the next category here, and we've got a lot to do, and I'm obviously not going to get all the way through it today, so which is why I'm going to sort of put some more video up in the learning module, in the chapter 10 module, a bit later in the week. And so let's talk about non-cash acquisitions. This is companies acquire assets without any cash at all for whatever reason. Maybe they exchange it for a note, and we're not talking about going to a bank and borrowing money because that would be essentially a cash transaction. The liability has nothing to do at all with the acquired company or the acquired assets. It's just simply they're exchanging for cash. And however the buyer came up with the cash is none of the seller's business. No, this is where the seller itself is usually saying, okay, we'll issue a note in exchange for that. It does happen where there are acquisitions where a seller will say, okay, you're going to buy us, here's going to be a note. And in fact, I think we're seeing a lot more of this now from what I'm seeing from some of my colleagues who are talking about the fact that a lot of businesses owned by the so-called baby boomer generation, which I'm on the tail end of, are starting to sell businesses to acquirers who don't maybe have the cash to do it. So as a result, they're entering into installment agreements, and that would be simply a note payable on the part of the acquirer. We're looking for the acquirer. Remember, this entire chapter 10, is the acquisition of assets. We're going to be on the other side of the transaction in the next chapter. We'll talk about dispositions, and any disposition is through sale or through forfeiture, repossession, destruction, whatever. But here we're talking about acquisitions. Okay, so that's one issue. Another could be issuance of equity securities. We'll get to that. We're talking about donated assets. This is one that's a little bit trickier. It's something that I don't know that comes up every day. Most accountants probably won't see it a lot, but it's often the case where a municipal entity is involved in sort of donating land or donating infrastructure like water lines, electrical, broadband, whatever, in order to sort of encourage some sort of investment by some unrelated private party in that case. And so we'll talk about that, or exchanges of non-monetary assets for other assets. And we see this somewhat in real estate development, where you are swapping one piece of land for another piece of land, and sometimes there's cash involved in order to sort of fill the gap, because it's probably going to be rare that you have two parties who have the exact same market values, who are exchanging those market values, who can connect with each other in order to make that transaction happen. So this is why cash is oftentimes this medium of exchange, at least in terms of plugging the value between those differences. And so, and we'll talk about the acquisition at fair value, or the fair value. So it's the fair value of assets given up or the fair value of assets received, which is ever more clearly evident. Now, I alluded to this a second ago when we talked about this idea that sometimes you don't always know the value of the assets you're acquiring. And that sounds completely crazy, but sometimes you really don't know. It's it's really difficult to put a value on. And there are some assets that are difficult, particularly with assets that don't really have a market for them. And so it's really hard to put a value on those assets, particularly in areas that are very cutting edge, and there's not a huge market for the acquisition of those assets. And so the better way to look at it is not what the fair value of the asset acquired is, it's what the fair value of the assets given up is. And in that case, that's how we're going to sort of hang our hat, because there are a lot of areas in where, there's really high-tech industries where it's just really hard to know what the value of something is. And so it becomes difficult. And we know these are out there, particularly in high-tech industries. I can't think of this as being anything other than that sort of example, but it nonetheless happens. Okay. So what do we do? All right. So let's go on to talk about. So let's talk about deferred payments. And so in this case, this is a very simple transaction. We're gonna acquire a machine for $15,000, and the buyer signs a note requiring the payment of $15,000 sometime in the future, plus interest at a realistic interest rate. Well, the initial journal entry is going to be the machine, $15,000 debit, and note payable of $15,000. Okay, easy peasy, no big deal there. Okay, all right, but it gets a little bit more complicated, particularly when we talk about the issue of long-term obligations, particularly even, and maybe even especially when there's no specific interest rate that's there. Okay, so let's talk about this, and this is important because it's going to involve discounts on a liability. This is a theme that's going to come up again and again, not just in intermediate 1, but also intermediate 2. So in this case, let's take a look at the example, and we'll take as much time as we need to, because I think this is really an important thing to know about. So on January 2nd, 2021, the Midwestern purchased industrial equipment. In payment, they signed a non-interest-bearing note, okay, requiring $50,000 to be paid on December 31st of 2022. In other words, 2 years later, all of 2021 and all of 22. So it's a 2-year obligation. If Midwestern had borrowed cash to buy the equipment, the bank would have required an interest rate of 10%. So we're going to use 10% as the rate that we are going to discount this note payable. We're saying, okay, any note payable that does not specifically have an interest rate should have an interest rate, because it doesn't make sense that they would not have. And so as a result, we're going to have to discount that note payable. The difference between those is the present value of the current obligation and the note payable in the long run. Okay. Now, let's talk about this, because this is not as straightforward as what it might seem. We're saying the equipment is worth $50,000. Not really. The equipment, we're going to bucket at the difference between the note payable and the discount on the note payable. And where's the discount come from? All right. So we're saying, even though there's no interest rate on the note, we're going to pay $50,000 in 2 years, right? We know that. So it's going to go as a liability, a long-term liability on the balance sheet, okay? We're going to figure out, how do we book the value of the equipment, okay? Well, first of all, the note's not payable for 2 years. So we're going to say n equals 2, and the present value of any dollar is n equals 2, and the rate is going to be 10%. So what do we do here? We simply go to our present value table, which obviously, if people use financial calculators now, but we're still, let's go old school here. Let's look it up here, right? So let's pull up, where is it here? All right, let me drag it over here, right? Present value table. All right, so the n equals 2. So we're going to go, my cursor, n equals 2, and the I equals 10. Now it's cut off here, and this is really, really super irritating to me that it is cut off, but you're going to end up with a factor here of 0.82645, okay, which is the discount factor. It's the present value interest factor of $1, right? Remember, this goes back to something we talked about in business math. If you took business math here, business 1180, where we said $1 today is worth less, it's worth more than $1 in the future. So $1 in the future, even the fact that dollars we're paying, not just dollars we're receiving, but dollars we're paying, those are worth more in the future than they are today. We have to discount those. And remember, everywhere in finance, you see the word discount. It implies, it's implicit that there's an interest rate involved. If there's a discount, somebody's foregoing something, and so as a result, we can express that in percentage terms. In this case, all we're simply saying is we're imputing an interest rate. We're saying it's 10%. Where did that number come from? We're just simply saying that if I were to do the same transaction with a bank, the market rate that would be paid would be 10%. Okay, but let's. So in this case, I know it's very irritating that the number is cut off there, but let's go back to if you just simply look at the screen here, right? And I want to. Let me get my where are we here? And I want to sort of scroll a little bit to the side here a little bit and do a little bit of math. And that is if even, oops, yeah, there we go. All right. And I want to do a little bit of math and simply say, okay, what is the formula that we're going to use here? It's going to be $1 over 1 plus I, which is the rate, to the nth power. So let's kind of do this here. So in other words, so the present value is this is really the present value interest factor is going to be 1 over 1 plus the interest rate, which is expressed as a percentage, 0.1, right? And it's all going to be, and that 0.1 is going to be to the nth power, the n equals 2, all right? So, so the nth power, right? So in this case, it's all, well, I just put 2, that's the value. So what is, it says 1 over 1.1 squared, okay? Which I believe is 1.21. I didn't bring my calculator, but if you do the math, you should end up with, and I think I ended up, my calculator only went to 4 decimal points, but you should end up with the amount here of 0.82, what is it, 8264? Let me see. 0.8264 or whatever. Let me just do the math. I got my iPhone. I should have brought my calculator, but I didn't think to do it. So 1.1 squared, right? And we're simply saying it's 1.1 times 1.1 is 1.21. 1 divided by 1.21 is 0.8264. Okay, 8264. And that's what we call the present value interest factor of a dollar to be received 2 years hence at a rate of 10%. Okay, so what do we do with that? And hopefully everyone is in tune with what's going on here. I know it's not real bright here. I turned the lights down a little bit in order to sort of make it easier to see the screen. But that's the calculation. All I've simply done was, this is a longhand, the longhand version of what's going on in order to calculate that particular rate. Okay, only because the table was cut off. But by the way, these tables are everywhere. They're ubiquitous. You can pull up gazillions of these present value tables everywhere on the internet, or you use a financial calculator if you want to do that. There are gazillions of those out there as well. This is a fairly simple transaction. What are we saying? Present value of a dollar to receive 2 years from now, or to be paid 2 years from now at a rate of 10% is this factor. That's the factor we're going to multiply by the present value of that particular asset. Okay, or I'm sorry, the particular value of the present value of the obligation, right? Which then becomes the value of the equipment now. Okay, so 50,000 times 0.8264 is 41,323,000, and that becomes the cost of the asset, right? If it weren't the cost of the asset, then if they wanted $50,000 today, well, that's a different story. All right, they want $50,000 in 2 years. Well, it must mean that equipment is not worth $50,000 now. It must mean it's worth something less. At least that's the way the accounting shakes out. So the difference between 50,000 and 41,323,000, which we got to by simply taking the present value of the obligation, that is the cash flow times the discount factor of 41,323, is 8,677, which is the discount. Okay. So that's the initial entry on January the 2nd, 2021, okay? But we're not done yet because we're going to sort of work through this. And by the way, you really do want to sort of follow this, particularly if you're going to continue with further accounting courses, because this is going to come up again and again. This idea of discounted notes or discounted bonds, whatever the case might be, any kind of obligation that's got a discount, and it is necessary to sort of follow this, okay? So this is the present value. And by the way, one thing I should say is that when we talk about if we book assets on the balance sheet at the cost or the price of those assets, then what is the value of the equipment? This is the present value of the equipment. And in fact, as I had a professor in graduate school say, price and present value are the same thing, right? If you're willing to pay for something now, it's the present value of that thing now, right? And if you have an obligation in the future, well, it's the obligation that is the issue in terms of discounting, not the value of the asset itself. So price and present value are one and the same thing. Okay. All right. So any questions about that and how we arrived at it? And I just looked at the present value table in the text, which is in the appendices to the e-text. It was kind of cut off and it's kind of irritating, but it is what it is. And so, but there are multiple of these tables are out there. So, all right, so let's take a look here. So this is the first transaction, January 2nd, 2021. All right, at the end of the first year, what are you going to do? You're going to take that amount times 10%. That's 4,132. And that's going to be a credit toward discount on notes payable. Okay. And the debit is going to be interest expense. We're going to recognize interest expense in that particular year. We haven't paid it yet, right? There's nothing that says that we're paying it. If we do pay it, then that's a separate transaction where we simply, obligation, pay interest and pay and debit cash, right? Or credit cash. We're not doing that, right? We're simply saying all we're doing is accruing interest expense. And simply the amount, the obligation, interest expense times the current value times 10%, 4,132, which were they're going to add to discounts and notes payable. Why? Because discount and notes payable is a debit balance account that is a contra liability, right? Contra liability, remember, any kind of a contra account reverses the account to which it refers. And so in this case, notes payable is 50,000, 8,677 is the discount on notes payable. Well, what we're going to do with that is we're going to then sort of reverse part of that. So 4,132 is going to partially reverse that, okay? To the point where this is going to have to go to zero at some point, right? Once the obligation is satisfied, because that discount simply represents interest that has not yet been fulfilled. So as a result, in this case, only 4,123 has happened. So we're going to add that to the, we're going to add that to, and we're going to take away the discount notes payable, and we're going to add it to the cost of the asset itself. And then so 323 plus 40,123 is new value times 0.10. 0.1 is 4,545. Together, 4,132 plus 4,545 is the 8,677. As a result, the note payable, which started out right at 50,000 with the discount, is now going to be 50,000, and we're simply going to pay cash to reduce that amount. That discount goes away. How do we offset the discount? Remember, the discount is going to be a debit. Is going to be is part of the notes payable. We're gonna credit discount notes payable because it started as initial debit, and we're going to debit interest expense. In both cases, at the end of 2021 and the end of 2022, these are adjusting entries that we're making in order to bring that discount down to zero. Right? Remember, discount notes payable is a contra liability, which is a debit balance, and the way we get rid of that is we simply credit that in both years, and we recognize interest expense, which is a debit. And so as a result, at the end of 2 years, that discount completely goes away, and all we have left is this transaction. Notes payable 50,000. Remember, it's a liability. Started as a liability of 50,000, which we're not debiting. To clear that, we're paying cash 50,000. So that now goes away. And so we have to sort of refer back to those original journal entries. The original journal entries are this: 41,323 for the equipment, 8,677 for the discount and notes payable. We talked about, and then the credit to offset those is 50,000 due in 2 years, right? And these are over time. These are the journal entries, right? Interest expense. Those are debits. Discount notes payable, debit. So debit, credit, and discount goes to zero over time. And as a result, that obligation is done once we pay it off at the end of the second year. And so that's done. And we have an asset on the books, and we still carry that asset on the books. Okay. All right. So, any questions about that as to what's going on with respect to that? So, we got about 17 minutes left, and I do want to. We're making pretty decent time here, but as I sort of thought at the outset, we're not going to have time to get through all this. But I do want to talk about other sorts of transactions. Any questions all so far about it? No. Okay. All right. Well, I mentioned a second ago, sometimes there are assets that we don't know what the value is of the stuff we're buying. And I know that sounds completely crazy, but sometimes there's no quotable market price. And this, believe it or not, this is not an uncommon business problem in the accounting world. And we've got different ways to deal with this particular issue as to assets. And this thing was sort of brought to light a lot during the financial crisis, where we had a lot of financial assets which were difficult to value, mostly because there was no quotable market in order to value them and whatnot, and whatnot. So it was really difficult to assign a value. But those are financial assets. Those should be easier. This is where there's really no market at all involved, and so we just don't really know what the value of the asset is. And so sometimes it makes sense. Now, what if we do know the asset, right? So, and we'll get to the unknown here in a second, but what about when we know the value of the asset? It's quite simple. It's the very same transaction essentially as what we did before. So in this case, we got January 2nd, 2021, almost the same facts. They bought a machine, Dennis bought a machine, signed a non-interest-bearing note. That requires the company to pay interest to pay $100,000. So that's the note payable. It's an obligation, a liability. We're talking about from the standpoint of the Dennis company here, not the acquiring, the selling company. And they're going to pay $100,000 on December 31st, 2023. In other words, all of 2021, 22, 23. So it's a 3-year term. By the way, this is wrong. It should be 3. The discount rate is correct, but sometimes they adjust these and change the numbers around. This should be 3. The discount rate is correct. So Dennis is not sure what interest rate appropriately reflects the time value of money. However, here we know what the value of the asset is. The asset is known. And not always do we know it. We're going to get to that in a second, but we know that it's what it is. And so, and this is what's going on. Where we don't know, what is the missing value here is the interest value. We don't really know what that is. I don't know how common this is, where we're trying to decide an implicit rate of interest, okay? But in this case, let's just kind of go with this sort of academic example where we know the value of the machine is $79,383. Well, the difference has got to be, we know that $100,000 is due in 3 years. So we're going to book this. This is a long-term payable, right? Long-term, and we're going to talk much more about long-term liabilities later. So then this is the asset. So the only way to get this to balance is the discount notes payable. How do we get to that? How do we get to where we have the present value of dollar in 3 years, not 2, but 3, and we get to 20,617. We just simply go into it backwards, and we end up with an interest rate of 8%, and that's the interest value that we're looking at. I do not think this is as common a scenario as not knowing the value of the asset, but nonetheless, that is one way to look at it. But it's going to be that. Okay. All right. So let's talk about deferred payments a little bit. A little quick quiz here. We have January 2nd, 2021. Edgar bought a machine, signed a non-interest-bearing note in payment. Again, if it's non-interest-bearing, we still nonetheless have to discount that because it's implied, it's an implicit rate of interest, and so we have to impute the rate if nothing else. So that requires the company to pay $200,000 on December 31st, 2023. Again, pretty similar scenario as to what we just talked about. Edgar's not sure what interest rate appropriately reflects the time value of money. However, price lists indicate the machine could have been purchased at $120. All right, well, we got a lot of stuff here, a lot of words, right? But the only question here is what is the value of the asset on January 2nd? It's $120,000, right? Now we will handle the accounting. We'll put a note payable for $200,000, and we'll discount that at whatever rate makes sense. It's going to be the difference between 200,000 and 80, and over n equals 3. All that we don't know is I, and so we can get to that. But in this case, the only question is, what is the asset recorded? It's what it could have been purchased for in a market in which we can reliably ascertain the value of those assets. Okay, we don't always know what the value of assets are, but so sometimes we have to go looking. And there are a number of different tests, and there's a hierarchy that accountants will use in order to determine asset values, particularly when it becomes really difficult to value an asset, particularly an acquisition or in other areas as well that we won't get to here. Is there a market we can look at to say, okay, this is what new goods, whatever this is, I don't know, new tractor or whatever it is, right? It goes for 120. Well, that's the price we're going to put on it. And if they're willing to accept 200,000 in 3 years' time, then we need to determine what interest rate it is. But we're not asked about that here. All we're really being asked is what is the fair market value of that asset? And the fair market value is the amount that we would purchase it for. And remember, when we talk about historical cost of assets, we are talking about at some point, theoretically, we're paying something like the fair market value or some difference between that. But the fair market value is the sort of the guiding light that we sort of key off of everything. Even if the price paid does not necessarily jive with the fair market value, okay? Fair market value has got its place, particularly in establishing the value of an asset at acquisition. Yeah, in the lump sum case, we had to allocate among a lot of different goods, right? This is a single transaction where all we really know is this is what the price of the good ought to be. They're just willing to accept 200,000. So, and we have to kind of do our math, right? We have to do our math. I mentioned on Tuesday that even though these are all commercial transactions, business transactions, these very same concepts apply to consumer transactions, where you buy a piece of furniture and they say 12 months same as cash, right? So in other words, you don't have to pay anything now; you have to pay in 12 months. Well, the question that a smart consumer would say, what is the price if I paid you now as opposed to 12 months? And you can kind of do the math and figure out what's going on there, right? And if they say it's the same amount, then there's something a little bit fishy, I guess, right? Because it should be a discounted amount, because a dollar in the future is worth less than a dollar today. So it should be a lower price as a result of that. And these are the kind of things that savvy consumers are aware of all the time, is the idea that if somebody's saying it's 12 months same as cash or whatever. I pick on the insurance, or I'm sure the furniture retailers, because we see this all the time where we have this idea that no payments for 18 months or 24, whatever the case might be, right? And the question is, what if I want to pay you now, right? Maybe I don't want to pay you, because if you're going to pay them over time, you're going to implicitly pay an interest rate that maybe you can borrow money today cheaper than what you could borrow from them. And so that might make sense for you to simply do that, okay? All right, so any questions about anything with regard to these concepts? We talked about lump sum payments, allocating the value based upon relative market values, and stretching those then and applying those to the cost itself, because we're talking about putting assets on the books of the balance sheet. And we'll get to some other examples, particularly when it comes to things like donated assets, if we have time today. And it really comes back to the definition of what an asset is in the first place, right? And how we acquire those assets. So, all right, so let's talk about issuance of debt, equity securities. This can occur sometimes when, particularly when smaller companies go public, or well, I should say incorporate, and the owner or owners contribute assets to the new corporation in exchange for equity securities. Let's forget about the going public thing here. That's a whole other can of worms. Let's just say we have a business that's now going to be incorporated. Now, a lot of businesses start out, they're not incorporated to begin with. That was traditionally the case. Today, it's so easy to start a sub-S corp or an LLC, which could be taxed as a corporation, but really operates with all the benefits of a corporation. But nonetheless, a lot of times companies start out as proprietorships. They're very small companies, maybe a small business, and they get bigger and bigger, and they need to then incorporate, where we're now talking about. Remember, the evidence of a corporation legally is the issuance of securities and stock. And so in this case, what we're talking about, what is the exchange value? It's either the fair value of the assets that are received by the corporation or the market value of the shares whose stock is actively traded. Now, if it's actively traded, it's a public company, but I don't know that that's necessarily what we're always talking about here. So it's going to be the fair value of the assets received by the corporation. In other words, now cash is obvious. I put in $200,000 in cash, it's worth $200,000. But what if I give you a building and a piece of land and an 18-wheeler over there? Well, then we got to sort of do a little bit of fancy dancing, right? In order to establish what the value of those assets being transferred are, in order to do that, okay? And so let's talk about this a little bit. So For pretty simple example to start with is on March 31st, 2021, the Elkhorn Company issued 10,000 shares, no par common, we don't care about the par value, in exchange for land. On the day of the transaction, the fair value of the stock, evidenced by its market price, was $20 a share. All right, so we're saying that's the value of the shares, right? It's $20 a share, and we're giving up 10,000 shares. So 10,000 times $20 is 200,000. So we're saying if we agree to the exchange here, we're giving up 10,000 shares in exchange for land, then the land must be worth 200,000, right? And hopefully buyers or both parts of the transaction have done their due diligence and they agree to it as going from that. And when we say market value, obviously we're thinking of a publicly traded company. Market value of a non-public company, non-marketable securities is a way different can of worms altogether. But it sort of simplifies our example here when we're saying we know the price per share is $20. We're going to give up 10,000 shares. So it must mean, therefore, sort of ergo, right, that the value of those shares must be, or the value of that land must be $200,000, right? Okay, the final topic we're going to get to is this idea of donated assets. And let's talk a bit about donated assets and what's going on here. Usually the donated assets come from either some interested party, like oftentimes it's a municipality, a county, a city, a state that wants to encourage a private party to do something. And it's oftentimes the case where there's an inducement made, we're going to build a road for you at this amount of value, and it's not going to cost you anything, so that you have an access road to get to the new plant you're building. We're going to put in water lines, electrical lines, phone lines, whatever the case might be. And so we're going to record those at the fair market value based on whatever the market price is or some appraised value. Okay. Again, this is where it's not always obvious what the value of things are. And so we're going to book those as a debit to the company receiving them. And so think about this, a debit coming into your company, an asset being received, isn't that a revenue? Isn't that the definition of a revenue? And remember, this is kind of wonky in academic accounting, but what is the definition of revenue? It's an inflow of an asset in the normal course of doing business in exchange for something else, right? And that's essentially what's going on here. It's a revenue. Now, the international standards are not quite as definitive on this, and so there is some controversy in this regard. But nonetheless, the question is, what is the fair value of the assets that are being received? And we're talking about this from the standpoint of the company that's receiving the benefit. We're not talking about the donor, which is often a government entity in the first place. It's the company that's has been doing the receiving. So in this case, we're back to Elkhorn. They decided to relook at its office headquarters in the city of Westmont. Westmont really wants this company here, so they're going to pay 20% of the $20 million cost of building the headquarters, right? So 20 million, 20% of 20 million is 4 million. That is going to be a reduction in the cost. So instead of paying 20 million, they're only the company Elkhorn is only going to pay 16 million. So credit cash 16 million, and we're going to create a $4 million revenue as a result of that. Okay, and the building was completed and all that. So so that's this very simple accounting treatment for that particular kind of transaction. We have to find a way to balance out that debit, and we do it through creating a revenue. Okay, and I do want to get to the international relationship in a second. So, quick one here is Shackelford Corp acquired a patent exchange for 50,000 shares of the no par common stock. On the day of the exchange, the common stock had a fair value of $22. Determine the cost of the patent. Okay, well, the cost of the patent is going to be 1.1 million because it's 50,000 shares at times 22. It's the fair market value, right? So that's on the day of the exchange. So again, we're looking at the fair value of the assets in order to determine that particular value. And then one final thing, because we're almost out of time, is the differential treatment here between GAAP and international standards. And under GAAP accounting, first of all, they're both similar in the sense that we're going to value under both US GAAP and IFRS at the fair value. So whatever those assets are, land, improvements to land, value of easements, value of improvements. I mean, the list goes on and on, right? So we know that, but the difference is in international. So in GAAP, we're recorded as revenue, okay, which we saw. That's the credit to offset the debit and the credit in GAAP. But in international standards, they will either deduct the amount of the grant from the cost of the asset, okay, so to lower the value of the asset, or record the grant as a liability, which is essentially a deferral, unearned income, which they will amortize over the asset's useful life. Um, and this gets a little bit tricky because how many assets are we talking about here? We're talking about pavement, and we're talking about phone lines, water lines, whatever. So it gets a little bit trickier. But what they're talking about is amortizing those over the estimated useful life of this. So it's a little bit more, I guess, more of a conservative treatment here when it comes to international standards. And I think that we see this a lot where the international standards, want to sort of be a little bit more cautious as to how some of these things are valued over fairly long time periods. Okay, so that's really what I wanted to get to, particularly when talking about donated assets. And donated assets, it does not necessarily have to be a government entity, but it often is. But it could be any other kind of entity. It could be a nonprofit that said that we want to donate. I mean, I had a client once that donated a lake to a city because they didn't want the lake anymore. It's like, okay, well, whatever. So it's like, okay, well, all right, and so you get the idea. It's not always the case of public to private. It could be the other direction as well, but you get the idea that this is how we handle this sort of treatment. Okay. All right. So, any questions before we sort of end this class session? I will again come in on Friday. I'll be here anyway. So, and I'll record a supplementary video in order to sort of round out what we're doing in chapter 10, because I know I want to sort of get through chapter 10 because the next couple chapters are a little bit lengthier, a little bit trickier, and in some ways not tricky in terms of difficult, but lengthier, more to cover. And I want to make sure we have ample time to do that. So, okay. All right. Have a great rest of your day, and I will see you soon.